See, so many people out there, I need a tax write-off, and they'll throw good money at a bad decision to just get a tax write-off. They let the tax tail wag the dog.
My name is Mike Mauceli, and this is the Energy Show with REI Energy, where we're energizing your investments and maximizing your tax deductions. Today, we're going to be talking about oil and gas benefits. It's tax season, and today you will discover how to invest in oil and gas and receive impressive tax benefits. My guest today is Mark Kohler. Mark is a CPA attorney, author, and senior partner at KKOS Lawyers. Well, Mark, thank you for coming on the show today. And I know it's tax season, and I know everybody's busy, but you do a lot of great work, and so I'm glad you put aside a little bit of time to talk to us today about oil and gas.
Oh, you bet. This is the best time of the year. It's like Christmas season. Everybody's opening up their tax returns, saving money. And, this is like a Christmas party having an interview with you. So,
well, yeah, it is that time of year. So a lot of people do invest during the year to offset some of their taxes. But, I started out, when I first met you, I read one of your books, which I think it may have been your first book. I know you've written 4 or 5 of them and spoke to thousands and thousands of people, on stage. But the thing I liked about it is it's like a lot of our investors and a lot of people that are just looking to do something different. And I think the name of the book was, what you don't want to ask your CPA. I believe that was the name of it. And, you went into it in the early part of the book about how you were kind of apprehensive to start a new business, and you were, you had been in the tax side of it, working for a big corporation until you met a entrepreneurial CPA, which I'm sure that is what you teach now. So, Mark, in your first book, I know you wrote a book about what your CPA isn't telling you, and you had met a couple in that book, and we're talking to them about actually doing some different things besides just paying taxes. Can you kind of go through that a little bit?
Oh, you bet. I love it. That book was my gateway drug for people because they wanted to like, what's my CPA not telling me? And so I wrote it in an analogy metaphor type story where this couple is very frustrated, and they turn the corner in a long dark hallway and meet this new CPA who was me, spoiler alert. And so I get to tell them about strategies their normal CPA doesn't even think about or know about, or it's difficult for them to share. Like this oil and gas tax strategy. So many CPAs kind of know about it, but they don't know how to engage with their clients and talk about it. And so that's what the premise of the story was too, is that people need to own the opportunity to talk with their advisors. And there's so much there that their CPA isn't telling them. And sometimes you got to drag it out of them.
Well, it was a great book, and I know you have a lot of different strategies that you work with people on, and about how to save taxes, because a lot of people they just come out and say, well, I owe the tax, I want to pay taxes. But I wanted to talk to you mainly today about oil and gas, and how that tax strategy works with individuals that are in accredited investors or high net worth individuals, and how they can actually use that strategy to save money and not pay the government.
Yeah. And this is one of those strategies that's very rare because it makes good financial sense and it saves us taxes. See, so many people out there, I need a tax write-off, and they'll throw good money at a bad decision to just get a tax write-off. They let the tax tail wag the dog. A classic example is the farmer. And farmers hate paying taxes. I grew up on a farm. I know them. And they hate paying taxes. And so in December, they'll go buy equipment they don't need just to get a tax write-off. That's why you drive by so many farms and you just see rusted old equipment out there that was a bad tax decision 10 years ago. And so the oil and gas investment is one of just 2 or 3 that make good financial sense, and they can have a tax benefit that's not hard to get, to harvest. You don't have to be some weird, I don't want to say weird, but a real estate professional. You don't have to quit your job. So it's really one of those strategies that just makes good sense anyway.
Yeah, and I know there's several different tax benefits that oil and gas offers. And so how does investing in direct drilling offerings, how is that a tax benefit?
Well, speaking as a nerd here, I guess I've told you this before, I think there's four benefits to the oil and gas drilling cost strategy, if we call it that, the IDC. So if you talk to an accountant, in our minds, we're thinking IDC. And as a tax lawyer, we're always looking for an angle. So the four benefits are: number one, it creates cash flow. You're investing in something that's going to generate cash flow. Holy crap. Can we start there? Let's just, make a good investment. Number two, in all of your funds and many of the funds in your industry, there's an exit strategy. We want to get in, drill, start producing oil and gas, and within 3 to 5 years, get out and sell our operation to one of the big dogs, Chevron, Exxon, whoever, that'll buy this stream of income. And a lot of times you can get out of your drilling cost strategy or investment with a profit on top of your investment. So you're investing, creating cash flow, and getting a good chunk of your money back or more. And number three, we're getting one hell of a tax deduction because we're able to deduct through depreciation all of the drilling costs. That's why it's called the intangible and tangible drilling cost deduction. So you're going to bonus or depreciate all of these write-offs and accelerate them. So in the first or second year, you're almost writing off your entire investment against other income. And then number four, of the cash flow you get a 15% depletion allowance, which means 15% of all your cash flow right off the top is tax-free. So when you look at those four, it's kind of like this perfect cake. It's a perfect equation for the investor.
And I know, you said the first thing is obviously cash flow, and that's what you want as an investor. I mean, the tax benefits are great, but cash flow is king. And the good thing about oil and gas, especially the way our funds invest today, we're investing in, horizontal drilling projects and major shale plays. In the early years, you went out and you drilled a well and it was either hit or miss. You either made money or you lost money. And in these shale projects that we participate in, it's the two biggest risks are what's the price of oil and how much oil am I going to get out of the ground? Because you're going to make a well every time you drill a well because you're drilling into an organic rich rock. But still, these are expensive wells. And, the cost to drill one of these wells is close to $10 million. And so the tax benefits come in like you were saying, in a very big way, because not only do you the intangible drilling cost deduction, which is probably your biggest tax deduction, about 70% of the well is intangibles. Really, the only tangible items you have is the casing and the leases. And then, of course, you get the depreciation, as you were saying. And now I think we even get the benefit from the bonus depreciation that was passed, where we can write off 70% of the tangibles. And I think it's 70% this year. And then, of course, they're trying to reenact that through Congress, but we do get that tangible write-off as well. So how does oil and gas differ from other types of investments from a tax standpoint?
Well, the difference is in these projects, these funds, because as you said, Michael, you've got to raise a lot of money to go do one of these projects. And so there's going to be multiple investors, which means we're talking about accredited investor type structures that are SEC regulated, which is fine. What's beautiful about these is there's a way to structure it through a general partnership arrangement where these depreciation deductions become ordinary, which is the holy grail of depreciation. Because if I'm a doctor or a dentist or a lawyer and I go buy a rental property and I depreciate it, if I don't qualify through a real estate loophole, that depreciation is great. And I'll get to use it someday and all the write-offs when I sell the property, but currently I can't write it off against my other income. What's unique about the oil and gas is that they're able to be structured through legislation, because the government is trying to encourage this. They want us drilling in our within our borders, and they want us to create less dependency on foreign reserves. So there's all these tax structures and investments that have really fast-tracked an investor so that we can structure it in a way where you can still have a day job as a dentist, a doctor, or a lawyer, or whatever, and I can get that depreciation as ordinary and write it off against my other income. And so it's part legislation and it's part the structure. And I know in your funds, you allow people to choose. They can say, I don't need that write-off. I'll just take it as passive. Other people are like, no, I want that write-off. Put me as a general partner in this. And there's insurance protection. There's a lot to design there. You'll meet with your lawyer or tax advisor when you go through this. But it just makes it really unique. It's exciting because you're unlocking that depreciation based on the structure, and there's hardly any other industries that allow for this.
Yeah, it was interesting that you said they can come in as a limited partner as well, because, they get the same tax deductions, right? I mean, you can write off your tangible drilling costs, you can write off your intangible drilling costs as a limited partner, but you can only use it against passive income. So really, it's the same deduction. I guess it just depends on the investor's risk tolerance, right? Or if he actually needs that deduction this calendar year.
Yeah, and I think you've structured these deals so well. I'm full disclosure. I'm an investor in one of your projects, and I've been very, very pleased. And I don't make any money off anybody that moves forward with our,
Well,
I'm just sharing personal. I want you guys to know I put my money where my mouth is. So what's really neat is that you're able to, again, get involved at different levels financially and choose how much you want to invest and not have to worry about the risk, because you've structured them so well with layers of insurance and protection and a track record in this industry where they don't want to go after investors anyway. They're going after the insurance and the protection of a variety of structures behind the scenes. And so I would say the risk is very low. There's risk in everything, right. But it's really about, does that write-off benefit you right now? Is this the best move from a tax perspective when you look at a client's overall picture? So,
well, I know people are in different, they have different needs as far as from a tax standpoint. And I guess I got a question now. If an investor is in a state where he has state income tax and he pays federal income tax, can he still take that deductions against state and federal?
Yes. There are some states that are not aren't congruent with federal law, but very, very rare. And they're usually little exceptions that are a little odd, California being one of the more challenging ones. But right now, I'm not aware of any state that is not going to allow this IDC tax strategy in their state, as if you're able to take advantage of it federally. So it's really powerful for people that live in those blue states where your tax rate's pushing 8, 9, 10, 12, 13%, because the tax benefits just really, really add to the ROI. Because I'm looking at cash flow. What am I going to sell this for later? And what's my benefit on my tax return right now? And when you start doing the math, you're like, whoa, okay, now my rate of return just went through the roof. Because if I just go buy a stock on the Wall Street or an ETF, do I get a write-off for that? I don't get a write-off. I mean, I get cash flow, I get dividends, but I'm not getting a write-off. Here, I'm getting a tax write-off, and I'm getting the cash flow and the appreciation. And it's a business that we got to keep that. It's not a stock, it's a business. And it's just so exciting.
So if you're an investor and you're looking at an investment in oil and gas, and you look at the tax benefits, and if you're in a 37.5% tax bracket and you invest $100,000 and you get a 70% write-off, then that's actually around a $25,000 savings. As an investor, should you consider that as a return? because a tax benefit is a benefit, right? If you don't have to pay taxes.
Correct. And we want to look at what is my cash on cash return, what is my actual cash return from the cash flow.
Right.
But if I'm saving taxes by doing this investment, what is that actual dollar amount in savings? And I'm going to put that on the line as a rate of return as well. And then I'm going to put into the equation any sort of equity growth. Is there is any expectation that this $100,000 is going to sell for 110 or 120 or 150,000? And no one can predict it with exactness that, but we can look at your track record in prior funds to give people an idea. So the tax benefit is absolutely a part of the overall ROI. And this is why people buy real estate. They want mortgage reduction, they want equity growth, and they want tax benefits that reduce their tax bill. So this could mean an ROI in the first year of 30% or more on an investment. And then you look at your plan of attack and the trajectory and how long you're going to hold this. And it's just phenomenal.
So how do you plan for, because obviously if you take the benefits up front and, when you get ready to sell the property, say 5 years down the road or, whatever that date is, and, you have to pay recapture, right? At that point, how should an investor plan for something like that as far as, because they have to pay recapture when they sell the asset.
So when you're selling, and I'm just doing some quick research too, when you sell,
you have to
or
pay
have in the past prior funds, there's it's an asset sale to the Chevrons of the world, right?
Right. Or
and then then it's a depreciation recapture issue for the person, for the GPs.
Right. They have to pay recapture on the deduction that they took at ordinary income, is it? And so I'm just saying, if I'm an investor and I know that's coming and I have to plan for it. I mean, you make another investment during that time frame, right?
Let me ask you, if I can be so bold, and you may not want to say this on a podcast. Have any of your funds, interest in the funds or your funds, sold for less than the initial investment, or has there always been appreciation to some degree?
Well, there's always been an appreciation for some degree, but we have had funds that, have early on that have lost money, when we sold because of due to price collapse. But,
that's rare. Most of the time
it's rare. I mean, these funds don't really do that because we're not participating in one well programs now, but I know if you do decide to sell in the future, then, you do have to pay recapture on the deductions that you took. And my question is, from an investor standpoint, what is a kind of a tax strategy that you look at?
That's a great question, because when you think about recapture, a lot of people say, oh, well, if I have to claim the depreciation 3 years from now back onto my return, I'm not even going to do it. That's dumb. And I'll go, whoa. Do you want a tax deduction from the IRS today and use the tax savings that you just got for anything you want? Reinvestment, something that would help build your wealth? Or would you rather have that tax deduction from the IRS split up over 3 years and let the IRS use your money, or even just skip the deduction altogether? Say, oh, I won't take the deduction because I got to give it back anyway. People, depreciation recapture is something wonderful in the sense that we're getting use of our money early on, even if we have to give back the deduction later. It's a time value of money. I'd rather have my $20,000 in savings from the IRS right now than $5,000 and not have to give it back. I'd rather give me my 20 grand and I'll use it for 3 years and then maybe have to give back a portion of it later.
But by that time, you've probably made another investment, right? So that tax deduction just keeps rolling forward. I mean, obviously, if you're happy with the investment that you made, you're not just going to do it one time. So you're constantly playing that tax game.
Yep. And you're also going to be thinking ahead. You can say, okay, I'm going to have some recapture here on this write-off that I took. What is that dollar amount going to be? And it's very easy to calculate. And so if you're saying, well, I'm going to have to recapture X number of dollars on my tax return 3 years from now, now you can start to plan to offset that. I could do another IDC. I could do a real estate project. I could take advantage of some other strategies to offset it and plan for it. And in the long run, I haven't seen any client turn away depreciation just because it has to be recaptured. I'll take an interest-free loan from the IRS all day long. Yeah. And that's what we're doing.
Yeah, no, that's great, because that's the way I look at it. And a lot of the partners that we have in the, in our funds look at it is that, they don't shy away from it just because that is, and I'm sure there's a lot of investments out there that have recapture on them. But as I said, oil and gas is one of them when you go to sell the asset. But if you make a profit and you're selling the asset, then, you're going to reinvest into another program. So obviously you're going to stay ahead of that tax game.
Yep. And let me interject too, for those that say, okay, I want to go the limited partner route. I don't need the write-off right now. I don't want to worry about recapture later. It's more of a nuisance, if anything. I'll just take limited partner status, less risk per se even. And what happens to your depreciation then? Well, it goes into a carry forward bucket.
Right.
And so I'm not harvesting those write-offs, so I don't have to recapture them. I'm just going to stay a limited partner, pay zero tax on my cash flow. And if I do have extra write-offs, I'll use those against other limited partnership income. And oh, that's great. When it goes to sell, I don't have to worry about recapture. So you get to choose the lane you're in. And this is where strategizing with your tax advisor is just so critical.
Well, we hit on one important point a little while ago when you were talking about general versus limited, and, what's the risk for investors. And of course, we do carry insurance on every one of our partnerships and every one of our non-operators. And in most cases, in one of these very expensive wells, our maximum investment may be $500,000. And, for a well that's costing $10 million, and we're carrying $25 million worth of insurance on every well that we drill. And so I think that's one way that is another risk factor when investors are looking at it to invest in a general partnership. That's a question that comes up a lot. Is what is my risk? Am I, and the good thing about oil and gas, it's one of the only markets out there, I guess, or one of the only investments out there, excuse me, that gives you the option to become a general or a limited, because you don't necessarily have to run the business to be a general partner. You still get the deductions, even though you're not actively involved in the business in oil and gas, correct?
Correct. And that's what makes it different from real estate, where even if I'm a general partner in a real estate project and they're doing a cost seg on a big apartment building, I have to meet a material participation test. And there's 7 categories there. And so, but that doesn't apply in the oil and gas world. There's not a material participation rule. I just have to be a general partner. It's just a different set of rules when it comes to oil and gas versus real estate. So that's really helpful. And just one other key point here is that this whole process of deciding, is oil and gas a good project for me? Keep in mind that this is just a piece of your overall tax strategy or your wealth building strategy. And you can be very targeted with, I kind of call it like a smoothie, where you've got your bananas and your strawberries and your this and your that. And you're like, I'm going to make this tax smoothie. And if I can really do it right, I'm going to get the benefits of one strategy here to offset the drawbacks over here. Some of you might be doing a Roth conversion. I'm going to do a Roth IRA conversion, and I've got a tax bill I'm looking at. ooh, I'll do the IDC to offset that in a given year. Now I've got Roth money growing tax-free for the rest of my life. Holy crap, if I have depreciation recapture, sign me up. So it's just, it's a beautiful tool to have in your toolbox.
I'm glad you brought that up because from time to time, we have partners that ask us, well, can I invest in my IRA, into oil and gas? And I always tell them it's not a very good investment to take IRA money and invest in oil and gas drilling. Is that a true statement?
Oh,
Excuse me. Go ahead.
well, I would say no. If you're looking for the tax write-off on your personal 1040, not a good idea. Because if I want that write-off, I have to take that position as a general partner individually. And we'll come back to how to take ownership here in a moment from the legal perspective. Beauty is I'm a tax lawyer, so I can put the law hat on here in a moment. But but when it comes to the actual ownership in an IRA, if I take a limited partnership role, great. I'm looking at cash flow and what are you going to sell this drill for down the road? And what I've loved about your approach to your funds is you are looking at a project that makes financial sense first.
Right.
Then all the tax benefits are a cherry on top. And I really encourage people to, when you're out looking around at oil and gas projects, that's where I like what Michael's doing. And you have to look with that lens first. Is this just makes sense? And if it makes sense for you, it can make sense for your IRA. Now, if you want the tax benefits, you add that other layer.
I see. Okay. Well, that's good to know because I always thought that, investing through an IRA was bad, but the way you pointed out, if you invest as a limited partner, then obviously you're not having to take that deduction right now. You're not having to pull money out of your IRA, right? You can invest through your IRA if it's a self-directed IRA, correct?
Yes, yes. And so on your prospectuses, and people, you should be looking for this when you look at Michael's data, is you'll say, okay, what is my rate of return as a general partner with some assumptions on tax benefits? What's my rate of return on your last three funds as a limited partner? What was the cash flow? And what did we sell that fund interest for at the end? Divide it by the years you held it, and you go, wow, that was I'm just throwing this out, a 13% average annual ROI as a limited partner. How's your IRA doing, people? How's your 401k doing? Are you getting 13% cash flow and equity growth? If not, let your IRA do the deal as a limited partner. You can still come in as a GP yourself. You can do both. So it's so exciting.
Yeah, that's a great point. So go ahead.
Legal ownership. Let me hit that real quick. Legal ownership. With you're going to ask this of your professionals. So let's answer it right now. If you're going for the general partner position and wanting the write-off, you're going to take ownership in your revocable living trust. That's it. You can't do it in an LLC. I know some of you are thinking, oh, I'll just do it in an LLC and protect myself. We're a step ahead of you. Can't do that. So you're going to take ownership personally or in your revocable living trust. If you go limited partner route, now you can do that with an LLC. You can do it with an irrevocable trust. You can do it with your IRA, your 401k. But the general partnership route is going to be just through your plain old revocable living trust. You're going to get a K1 individually under your social that's going to drop onto your 1040.
I'm glad you said that because a lot of times people will say, well, I'll just drop it in my LLC and I want to be a general partner. And I say, no, I don't think you can do that, but you need to. And it was kind of leading into my next question is, should you consult with your CPA before making an investment in oil and gas?
Yes, but that's an interesting question. I've got a tax advisor network I've been building now for 2 years, and we have over 600 CPAs, enrolled agents, tax attorneys, and financial advisors around the country in my certification program to be a qualified or certified tax advisor. If your accountant doesn't even understand this strategy, please go to my network. It's on my homepage, markjkohler.com. I'm sure it'll be in the description, and interview and find a better tax advisor. That's step one. If you ask your accountant, hey, what do you think about the IDC? And they go, you mean the IBC root beer? I love that. Then you've got the wrong accountant.
Well, I'm glad you said that.
So we're not talking about root beer. We're talking about intangible drilling costs. So if your accountant is already in the dark regarding the strategy itself, you've got the wrong accountant on a variety of levels. Should you ask your accountant if it's a good investment? Accountants can be the most conservative, stick up your butt people out there. So you got to be, they're going to freak out. You can ask them if you're going to buy a little single family home rental without them falling off their chair. But if you want to ask them, what's my adjusted gross income look like? What's my projection for next year? Could we do some tax strategy here? Would an offsetting IDC deduction work for me? And even tell them, don't tell me what you think of the investment. Tell me what this is going to look like on my tax return. And so you've got to sometimes keep your accountant in a box, or they're going to talk you out of anything. And we've got to be careful there.
That's great advice, Mark. I appreciate that, because I know at the end of the year, we get a lot of accountants that call after they get their K-1s, mainly because they're not in an oil producing state. So they don't deal with a lot of investors and oil and gas, information, or on their K-1s of what they can write off. And I'm glad that you're actually out there training a lot of CPAs. And I know you do a great job at that on, the different, from being an entrepreneur type of CPA as opposed to just being a conservative CPA, right?
Well, I appreciate that. I'm going to piss off some CPA here, but and I know a lot of tax advisors listen to your show and watch it. So I do want to say this. I'm not trying to beat anyone up. The accounting industry is on fire. There are so many seasoned accountants that are just burned out, frustrated, and continuing education doesn't cut it. The continuing education, although it be great that it requires ongoing learning, those instructors are afraid of their own shadow too. Is there any cutting edge strategy planning going on in CE today? Do you learn this on your CPA exam? Do you learn this from the old guy in the corner that was here in 1985? Do you learn this from the bar exam? You don't. Where do you learn this? And so I myself have learned this from networking on the streets with accountants and enrolled agents and CPAs around the country for years, and finally bundle it up into a community. And there's nothing like it that I'm doing that's out there to help advisors level up. And so all of you listening here, if you want to make more money, if you want to live your American dream, sometimes you have to level up your professionals as well. And if you bring up this topic and they look like a deer in headlights, just tell them thank you and walk away from your brother-in-law and just talk to him at reunions. It's not worth it.
Great advice. So anyway, I wanted to switch gears just a little bit, because we got a new product that's coming out, and it's a oil and gas mineral fund where we're buying minerals, and where the investor is actually, and it takes the position as a landowner. Now, I know there's not a lot of tax benefits for minerals, but are there any tax benefits out there for buying minerals or royalties?
Well, passive income is always better than ordinary income. And doing these types of projects, to me, sound incredible in a retirement account. Because we're not going to see the depletion deduction. We're not going to see the depreciation from oil rigs. You're in a royalty land ownership position, which is perfect for capital gain treatment. So you're going to get long-term capital gains, and also for retirement accounts. And I just think that is going to be a area that I would focus on, Michael, with your group, is letting people with the $13 trillion in retirement accounts out there, realizing that this is another position that could get them a double-digit return.
Yeah, that's probably that is the main reason why I'm coming out with the fund, because there is a lot of money out there sitting in IRAs and 401ks that, can be put to work and in those type of investment vehicles. But also, we've done about 55 1031 tax-free exchanges where investors are coming out of real estate and going into, oil and gas. And so we just completed a mineral 1031 tax-free exchange a couple of weeks ago. And so I think it's a great product. It doesn't offer the benefits that a drilling program, but when you combine the two, obviously it gives you some diversification.
No, I'm glad you brought up the 1031. That is another tool that you wouldn't normally use in a drilling project, but one of these mineral projects, because we're dealing with real property, the 1031 doors open, which is exciting. You could even pull opportunity zone. Well, no, you couldn't do opportunity zone there. Sorry, I'm just brainstorming here. I love to start thinking of strategies, but love the 1031. That's a great fit too. And the retirement accounts at that level.
Well, Mark, it was great having you on the show today, and I'd love to have you back in the future.
Oh, the feelings likewise. I just love what you're doing. I just think of you and Bruce Willis with your shirt off out there under an oil rig, just sweaty and, some heavy metal playing. I'm Ben Affleck. I'm Ben Affleck, if I could, and then
I just wanted to date his daughter.
Oh yeah, there you go. Yeah, I get Liv Tyler then because I'm Ben Affleck. So I mean, for those that haven't seen that oil rig scene, that's a good one. But no, it's just exciting what you're doing. We grow up. A lot of kids nowadays, oil and gas seems like something that happens in the Middle East, or Beverly Hillbillies, the black and white show. Oh, that was far. No, this industry is alive and well. It's exciting, and investors just don't hear about it because Wall Street doesn't make as much money on it. So they're not telling everybody, and it's just, I love what you're doing out there. Keep spreading the good word.
Well, can you tell our listeners how to follow you?
Oh, yes, please. Get over to markjkohler.com. It's easy schmeezy. There's so many resources there. You can get to my law firm from there, find a tax advisor from there. I have a weekly newsletter. We have 2 podcasts ourselves with millions of downloads. Everybody, you've got to have a voice that's in your ear for tax and legal strategy. There's a new bill in Congress right now. We've got court cases on the Corporate Transparency Act happening. We're going to keep you up to date so that you can better manage your professionals. People, you got to captain your ship. We'd just like to be one of your lieutenants on the ship, giving you quality information to captain your own ship. Don't rely on anyone to steer your ship. You get to steer it, but I want to be one of those voices to help you reach your dreams. So get over to markjkohler.com and just start following us on all the social media platforms as well. You'll find a huge amount of information that'll be helpful.
Thank you, Mark.
This podcast is a presentation of Rich Dad Media Network.